So, what if a playbook written by the US government all the way back in 1933 is being dusted off for the digital age? Well, this analysis we're diving into makes a fascinating and, for some, pretty frightening argument that the new target is Bitcoin. And the source material really doesn't pull any punches. It kicks off with this incredibly provocative claim, arguing that a historical pattern of wealth confiscation isn't just something for the history books, it's a current event in the making. Okay, so to really get this argument, we have to go all the way back to the Great Depression. The whole theory, it really hinges on this one controversial executive order from 1933 that went after gold. Right, so on April 5th, 1933, President Franklin Roosevelt signed this order. And let's be clear, this was not a suggestion, it was a demand. If you didn't comply, you were looking at a staggering $10,000 fine. That's about 230 grand in today's money, and up to 10 years in prison, all for just owning a piece of metal. You know, what's really interesting here is the sequence of events. It wasn't just one single action. First, you get the order and a hard deadline. Then, the government waited until after all that gold was collected to make its next move. So, this wasn't an outright seizure in the way you might think. Citizens who followed the law and turned in their gold coins and bullion, they were compensated. They got the official government price for their assets. And that price was $20.67 per ounce. Now, this was a rate that had been fixed for decades, so at the time, it probably seemed like a fair, even if it was a forced transaction. But here's the twist in the story. 9 months after that deadline, with the nation's private gold stash secured in government vaults, the rules of the game just changed. Dramatically. By presidential decree, the official price of gold was suddenly $35 an ounce. Just like that, overnight, the US dollar lost over 40% of its value, against the very same gold citizens had just been forced to sell at that lower price. And they couldn't buy it back. Ownership was now a crime. Okay, let's jump to the present. The source argues this 90-year-old story isn't just history. It's basically a roadmap for the economic pressures we're seeing today. In this chart, wow, it really illustrates the scale of the problem as the source sees it. Back in 1933, a 40% debt-to-GDP ratio was considered a national crisis, enough to justify confiscating gold. Today, that ratio is over 3 times higher, sitting at 132%. The analysis points directly to this number, $37 trillion, as a debt load so absolutely massive that it just can't be paid back through traditional ways like taxes or economic growth. And this, it argues, forces the government to start looking for some very unconventional solutions. So here's the crucial point the source is making. When you're faced with a similar but frankly much larger problem, you might turn to the exact same solution, confiscation and revaluation, just with a brand new asset. The core of the source's whole argument is laid out right here. It points to a supposed future executive order about Bitcoin and highlights what it calls mirrored language straight from 1933, declaring the asset a strategic asset, calling it vital to national security, and giving the Treasury the authority to acquire it.
So if this were actually to happen, how would it work? The analysis goes way beyond just theory and lays out a very specific 4-phase plan for how a digital asset confiscation would be executed.
According to this view, the process kicks off by establishing the legal authority. Then it moves to getting the asset, first voluntarily, then by force. And the final step, just like in 1934, is a huge revaluation to basically fix the government's balance sheet. But, and this is a big but, the analysis argues there is one massive difference between grabbing gold in the 1930s and grabbing Bitcoin today. And that difference is technology. Think about it. Back then, the government had to rely on people's trust and fear. They couldn't realistically go check every single home for hidden coins. But the source argues that today, know your customer rules at crypto exchanges have essentially created a perfect database of who owns what, making enforcement incredibly easier. Now, this analysis doesn't present this as some far-off possibility. No, it lays out a specific and very near-term timeline for how it predicts these events are going to unfold. The predicted timeline starts this year with a quiet accumulation phase. Then, a crisis in 2026 gives the political cover for the main event in 2027, mandatory acquisition and revaluation. And all of that establishes a new normal by 2028. Given this pretty stark prediction, the source doesn't just lay out the problem. It also offers up a potential solution, a kind of survival guide for protecting your assets. The most crucial point here is all about custody. According to the source, any crypto held by a third party, like an exchange or an ETF, is at super high risk. In contrast, assets that you hold in self-custody, where only you control the keys, are much, much harder to confiscate. And that leads to this list of protective measures. The advice is pretty direct, from technical stuff like moving your crypto to a hardware wallet, to more traditional moves like investing in physical assets, land, real estate, privately stored gold, and even diversifying internationally. Ultimately, the source frames its entire argument on a much grander scale. It claims this isn't just about the government targeting one asset, but about managing a historic transition away from the current dollar-based financial system that we all know. And so the explainer leaves us with this final, really provocative thought. It presents this scenario of a massive, government-led wealth transfer, and then asks a simple but profound question. If this happens, how will you be positioned? Which side will you be on?